Hello dear friends, my name is Clive Thompson. It's Sunday 21st of September 2025. I'm here to give you the news for the last 7 or 8 days, in other words for the whole of the last week related to the stock market, the economy, finance, investments, politics and so forth. So let's start with the most important news of the week. That was the FOMC meeting, the Federal Open Market Committee meeting, and we had the press conference on Wednesday evening in which Jerome Powell announced what we expected, which was a 25 basis point cut. And we'll have a look at that on the chart here. So you can see the interest rates just dipping down here. It was the first interest rate cut this year. So we're already in September. So we've had 9 months without a cut. The last cut came in December last year, which you can see there on the chart. So we've just gone down 25 basis points. During the conference, Jerome Powell emphasized repeatedly that the labor market is cooling off and that there are increasing signs of, or rather risks to employment. And I think he's got a very good point there, because if we look at the unemployment rate, the official unemployment rate going back in time, or going back to 1997, you can see it swings up and down, up and down, up and down. It's swinging up now, at least since I would say, since April or March 2023. The unemployment rate then in March 2023, a year and a half ago, was 3.27, 3.25, something like that. Now it's 4.30%. So the unemployment rate has risen from, let's call it 3.3% to 4.3% in the space of a year and a half. And you see that rise there. But what other signs have we got that the economy is slowing? Well, if we look at the non-farm payrolls numbers, I'll just bring that over a bit here, ignore the COVID spike there. You can see that month after month almost, it's a bit of a zigzag pattern, the non-farm payrolls, the new jobs being created, are sliding. Jerome Powell had said previously, back in July, he said we expect that job creation would average around 150,000 new jobs in the per month in the second half of the year. Well, we've not had the 150,000 new jobs level would be about here on the chart. So we haven't had that in the last 1, 2, 3, 4 months. As you can see, the last figure was 22,000 jobs created, if you believe that number. Anyway, that's 22,000, way below the 150,000 that he thought that we would see. So, and don't forget, they've been revising these job numbers down every month. They tend to revise the previous months down, which always makes the current month look that much better. So I rather doubt that this 22,000 positive jobs will actually end up being a positive job number. I suspect it's going to be revised downwards just to make next month's number look that much better. But we shall see. But let's look at the number of employed working full-time. Well, that's clearly stagnating. So where are all these new jobs going? If the number of people working isn't going up, yet they got all these new jobs being created, where are they? So the number of people working full-time stagnated. Let's look at the number of job offers. Oh dear, that looks grimy, doesn't it? Look at that. Since 2022, the number of new job offers has been falling month after month. It's almost straight down. So it peaked, we had in 2022, in March, we had around 12.25 million jobs on offer. And that's been going down every month virtually. And now we're down to 7.2 million jobs on offer. Down from 12.25 to 7.18. That's a huge drop in the number of jobs on offer. And if we look at the number of payrolls here, this is an interesting number. You see the zero sign, the red line. That is the number of jobs. So 0 is the number of jobs created. According to the payrolls number, we have got negative jobs being created almost every month for the last year, going back to, well, December 2022. In fact, you look at that, that's net. I mean, it's the occasional month above, but most of those results show less than zero jobs created, or not less than zero people in payrolls. So it's quite obvious that these non-farm payrolls look like they're going to be revised downwards, but that's the number the whole world focuses on. Hey, we've got a fantastic non-farm payroll number, lots of people got new jobs, great. Then next month they revise it down. Well, looking at this, there's less people in work, less jobs on offer, more unemployment. It doesn't look to me at all like we should be relying on that non-farm payroll number. Let's just have a look at this chart here. Where is it? This one, that one we're looking at. You can see much more clearly the number of job offers falling off a cliff there. And if we look at what happens when we've had rising unemployment. So remember a few minutes ago I showed you the chart. We have the unemployment rising for many months now, and I'm looking at the chart here going back all the way back to 1970s, in which you can see that every time we had rising unemployment there in 1969 going to 1971, rising unemployment, recession. So the red bands are the recessions. So you can see that again in 1973-74, again in 1980, 79-80, then again in 1981-ish, again in 1990. In each of these recessions, unemployment was rising. So the recession started when unemployment started rising. And you can see it there again in 2002, and there again in 2007. We had the COVID recession, so we'll just ignore that one, but the same thing happened. And now the recession looks like, according to the unemployment numbers, looks like it would have started a good year ago, because we've had a year now of rising unemployment, over a year. So where's the recession? Not declared. So it could well be that they'll revise the economic numbers down and declare the recession later, because every one of these recessions has looked like this in terms of unemployment, and I'm counting them: 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 recessions had a pattern exactly like this, of rising unemployment. So I'm expecting the next number to come in and show us that we really are in a recession. Let's just have a look at what the Fed Watch is expecting for interest rates. So currently, we're now at an interest rate of 4 to 4.25. We'll call it 4.25 for simplicity. What's the expectation? Well, the expectation for the next meeting, 29th of October, is a 91.9% probability of another cut of 0.25%. So they're expecting the interest rates to be cut from the present 4.25 to 4. They'll call it 3.75 to 4 is what they'll call it. So it's coming down to 4, and there's only an 8% chance the rates will stay where they are. But then, and there's a 0% chance that they'll be cut by more than 0.25%. At least that's the way the market is thinking today. But if we step forward to how it's going to look, that's the October meeting. But we've got some other meetings coming up before the end of the year. Let's have a look at those. We've got after October, we've got the 10th of December meeting. And as you can see on the chart here, they're showing another cut in interest rates, another 0.25% to 3.75%, which we call 3.5 to 3.75. The chance of that happening is 78.6%, with a 20% chance roughly of the 3.75 to 4, and only a 1% chance that it will still be where it is today. So according to these numbers, we see a high probability of a rate cut in October and a high probability of a rate cut in December. That's what the market is pricing in at the moment. Those numbers, of course, can change. But it does look very much like we're going to get 2 more cuts in interest rates in the USA before the end of the year. So how are the stock markets taking all this? Well, let's go and have a look at the stock markets now. Here's the Dow Jones Industrial Average. As you can see, it just hit an all-time record this week. Excuse me. Let's go back to the long term and look at the long term. There you are. You can see it's been accelerating to the upside in the long term. I'll perhaps look at the 5-year chart. But yeah, there you are. That's an all-time high. And I'll look at the 5-day chart just so you can see exactly where the high occurred. In fact, yes, it was clearly here. That's the all-time high. And it was on Friday, the 19th, the day before yesterday. But let's have a look at the S&P 500. Another chart, all-time record. That was up 0.5% on Friday. And Nasdaq was up 0.7 on Friday to, guess what, an all-time record. But it's not just in America where stocks are going up. If we look at the UK, it doesn't look like a record on the 5-day chart. But if I bring up the all-time chart here, you can see the FTSE's as near as makes no difference at a record. The DAX, the German index, as near as makes no difference at a record. The CAC 40, the CAC 40 in France, that's as near as makes any difference a record. The Europe 50 index, that is at a record. The Nikkei 225 index, as you can see, that has hit a record. If we just go really short term to 5 days, you can see that record came, I guess, on Thursday. Came off a little bit on Friday, not much, but it's as near year to date. Let's look at year to date. As near as makes no difference, an all-time record. I can go back to the all-time and see that. There you are. There you can see it's clearly a record. And the Hang Seng Index bottomed out in mid-2023. Let's make that a 5-year chart. So you can see Hang Seng Index has been rising since January 2024. So that's a year and 3 quarters. Again, upwards. This wall of money is coming into stocks. Why is there a wall of money? Well, there's several sources. One, international investors around the world are maybe feeling a little bit less certain about their dollars, and they're looking to change into something else, just out of caution. And we see that because the dollar's been falling. We see the dollar's fallen 11% since the start of the year. So that tells us that international investors are bailing out of dollars. And of course, one of the places they go to is the stock market. That's one reason. Another reason is the US money supply, which has been on the rise. M2 is rising. So with more money coming into the system, there's money out there for people to buy things. And the third reason is the increasing levels of government debt. So as the government runs a deficit, that means it spends more money than it collects in taxes. That's a deficit. As it runs the deficit, it has to borrow the money to pay for its spending. It's like, it's like a credit card. If you spend more than you collect in salary, you have to borrow the difference. So effectively, the government is borrowing the difference of what it spends more than it collects in taxes. And that's running to the tune of about 2 trillion a year. That's a pretty big number, by the way. I won't explain how big it is, but it's just really, really big. So it's needing to borrow around 2 trillion a year. So as it borrows, the government gets poorer because the government owes the money, but someone else gets that money. So someone else, or everybody else, depending on how you look at it, gets richer. And clearly they're not buying government bonds, so they have to buy something. And what do they choose? They choose asset classes of all descriptions. So, just to illustrate that, I'll just show you a little chart of something I did here. There we are. So here we have some indices, some mainstream indices. The Dow Jones at a record, the Japan index at a record, the FTSE 100 at a record. I'll just move. Federal debt is at an all-time record. United Kingdom debt at an all-time record. French debt, I just took 3 countries as an example, but it's similar all around the world. French government debt is at a record. Money supply in Europe is at a record. The consumer price index in America is at a record. US house prices at a record. the gold prices at a record, Bitcoin prices as near as makes no difference a record, and I just put one commodity down here, it's meat, but you can see the price of meat is not going down. Well, yes, it's at a record actually. So we see a lot of things at all-time records at the moment. So how are interest rates reacting to this? Let's have a look. Here you see the US government 10-year bond, and the white line you see here going down, that's Wednesday's FOMC meeting, and it's the moment they announced the cut in rates by 0.25%. Yet, despite cutting the rates, the interest rate on the the interest rate of the 10-year bond has risen from 4.04 to 4.14, up 0.1%. Likewise, on the 30-year bond, the interest rate since the cut here, you see the spike down, that was where this cut happened on Wednesday evening. That's European time at Wednesday evening. You see the interest rates have risen on the 30-year bond. Why are the rates rising? Well, several reasons, but first of all, cutting the short-term rates is seen as inflationary. So people are expecting money printing further down the line, so they demand higher interest rates on the long end. Secondly, the cutting of the rates is a confirmation that the economy is slowing, and that means recession, perhaps. And if we have a recession, the tax receipts will be less than the government expected or wanted. Therefore, they'll have to borrow more. And if they borrow more, they're going to be borrowing 10-year bonds, 20-year bonds, because they spread it out across the yield curve. But the more they want to sell of these bonds, the lower the price is going to be, because people buy the first bond at a higher price, but the next bond at a lower price, the next bond at a lower price. So as the prices of bonds go down, the yield goes up, which is what's happened last week. The yield's gone up because people expect the government to be forced into selling more bonds down the line. Now, going to currencies, as you see, the dollar has been falling since the start of the year. That's the start of January, and down, all the year down. Last week it hit, in the middle of the week, it hit the lowest point ever when the day before they announced the interest rate cut. But we started the year at around 109, 110 on the dollar index, DXY. DXY is a basket of international currencies against the dollar. So basically it means the dollar's been going down against that basket. And it's gone down from 100, let's call it 110 for simplicity, to 97.65. It was 1% below that at 196.4 last week. So the dollar at the moment is about 11-12% down on the year, which might explain why all those stock markets and everything else is going up. People are bailing out of the dollar to go into other things. Now, what about gold? Let's just have a quick look at the Swiss franc against the dollars. So the Swiss franc here has been rising all year since the beginning of 2025. And let's see how the Swiss franc's been doing long term against the dollar. Well, we're going back to 1990. 1990, one Swiss franc would have bought you 60 cents American. And today, one Swiss franc buys you $1.26 American. In other words, the Swiss franc buys you more than twice as many dollars now as it did in 1990. Is that the Swiss franc being strong or the dollar being weak? Well, actually it means the truth is they're both weak. It's just the dollar has been the weaker of the two. But let's go now to gold and see how that's doing. So this week on Tuesday, gold hit an all-time record. Let's bring up the long-term chart of gold there. You can see it about there, going up and up and up like a straight line. I'll reduce that to 5 years to make it more readable. There we are, and I'll make it a 1 year chart too. Yeah, as you can see, all-time record. It wasn't quite a record on Friday, but Tuesday was the record, and we're as near as makes no difference to that record. So we're probably going to move higher in the week, I think. Silver also surprised to the upside. Over $43 now, $43.09. So that clearly is a record for many, many years. It's not been like that for maybe 10 or more years. Yeah, we have to go back to, what year was that? We go back to about 2010, I think it is. Yeah, 2011 maybe. Yeah, 2011 was the peak when it was just below $50. Well, it obviously did touch $50 at the time, but you can't see that on a monthly chart. So anyway, silver performing very well. Don't forget the 25th of September is the end of the consultation period on whether silver should be a strategic mineral of the United States. Assuming that consultation comes to an end and there's no objections, I'm guessing that as it will be a strategic mineral, they'll have to start to stockpile it. Last time the government stockpiled it, they had 2.1 billion ounces in their stockpile. That's all gone, been used on building bombs and God knows what else, but it's all gone anyway. Some of it was auctioned off. So 2.1 billion tons is about 2.5 years mined production. So I don't know where they're going to get the silver from this time around. They certainly can't buy it in any hurry because all of the mined silver is spoken for, because the consumption of silver has for 2 or 3 years exceeded the mined supply, and all the forecasts are the consumption of silver will keep rising and the mined supply is not going to keep rising. And why is the consumption rising? Well, it's electronics, of course weapons as well, but most of it's going into electronics and solar panels, that sort of thing, and your iPhone and anything else which uses electricity and needs a perfect circuit will be using silver. So I think the number of electronic devices is not going to go down, and therefore I think the demand for silver will continue to rise from the industry. Silver's pretty slow to react to price rises from mine production because, first of all, it takes many, many years to bring a mine into production, maybe a decade or more. But the second problem is this. Most of the silver which is actually mined is mined in conjunction with something else like copper or gold. And therefore, it's not so much the rising price of silver which caused people to mine more. It would be more a rising price of gold or a rising price of copper would perhaps boost the price of silver. And of course, that's happening. Gold is going up at the moment, maybe not copper at the moment. Let's just have a quick look now at some of the big price changes during the week. Just a sort of quick word on crypto. Bitcoin traded at above $115 in the week, and Ethereum at 4,500. Currently, Bitcoin is at 115,667, and Ethereum is at 4,445. Big cap movers. We saw a huge rise in the share price of Intel. And let's go to have a look at that. Give me a second or two while I bring it up. So why did Intel rise? Well, Nvidia is investing in Intel. There's your chart of Intel. You can see it rose by 22.9% last week. And that was after Nvidia said they're going to make a $5 billion equity purchase of Intel. I don't see here whether they are buying the shares directly from Intel or whether they are buying them in the stock market. But obviously Nvidia is hedging its bets and are going to collaborate with Nvidia in terms of producing chips. Another company which did rather well on the back of artificial intelligence last week. I mean, it seems that every story which comes out has got something to do with artificial intelligence, and it seems it's the buzzword of now which moves the market, just like in the late 1990s where .com or .sys or .net would move the price of a stock up, and in the early 90s, just getting an email address was enough to move a stock up. So yeah, today it's AI. So when you hear that word AI, think, how's this going to change the price of the stock? Because often it does. So ASML, why did they rise? Basically, improving outlook. So they're expecting better earnings. That's it. Another company which went up. Here it was Novo Nordisk. It went up in the week by 11%, 11.6%. The official news, and what they'd have you believe, is that the stock jumped because of the product they're producing, which is called oral Wegovy, and they had some favourable trial updates, and the analysts brought out positive commentary on that. That was at a diabetes meeting. Now, Novo Nordisk, their biggest competitor, I suppose, is Eli Lilly. They both have anti-weight loss drugs, which is in both cases an injectable drug, and both of them are working on a pill form of the drug where you take a pill to lose weight. Now, whichever one of them gets that license to use the pills, or perhaps both of them, that will be a catalyst for higher share prices if they get the license. But as I said, the news last week was about the positive clinical trials. Perhaps wasn't the whole story. Last week, Novo Nordisk also announced it would fire 11,000 employees, or 10,000 employees, which is 11% of its workforce. Now, those job reductions will take time to work their way through the system because they'll have to give people notice and they'll have to give them gardening leave. So probably by the middle of next year, they'll have got rid of these 11,000 people. Why are they getting rid of 11,000 people? Well, they didn't say, but a few months ago, they were boasting about how successful artificial intelligence was in their firm. Basically, the gist of it was that they can now produce the kind of documents needed for the Federal Drug Agency, FDA, in much less time. They can produce it in, I think they said, days or weeks instead of months, and they don't need nearly as many staff to produce it. Obviously, efficiency gains there, but maybe they're applying this artificial intelligence all across the whole company, and more people are saying, my department doesn't need as many people because I've got two guys who know how to use AI. They're the bright ones, and they can do the work of the rest. So could be. I'm speculating here. But anyway, Novo Nordisk was a great one last week. Another one which went up quite a lot was Tesla. They are expecting, or the market is expecting, high Q3 deliveries. I think there's a technical thing there because the tax credit you get with a car, I think it's quite a lot of money, something like $7,500 maybe. The tax credit is going to go away at the end of September. So what may be happening, a lot of people may be rushing to buy their car, their Tesla, before they lose the benefit of the tax break. So that expectation of higher sales pushed Tesla shares up 7.6% on the week. Another stock doing really well was Apple. You can see the rise in Apple there. There's midweek, and later in the week, I think it was Thursday, or maybe it was Wednesday, I'm not sure, they had their annual conference and announced the iPhone 17, and they also announced some AirPods which will translate foreign languages on the fly as you speak as someone's speaking to you, which sounds quite exciting. They also announced a new Apple Watch, the Ultra 3, and funny enough, I've got one here. And I managed to get the iPhone 17 to, looks nice, doesn't it? Yeah, I've got a yellow cover. Wanted to look a bit different. So Apple doing well out of that. What else is doing well? Louis Vuitton. In the week, you can't really see it on the chart here because they've fallen so much earlier in the year on the back of the China recession and things like that. And obviously the tariffs aren't helping Louis Vuitton. But they did have a bit of a leap just this week. I'll bring that forward to look at the last month and it may be a bit clearer. There you are. On a monthly chart, you can see that leap upwards in Louis Vuitton. Ostensibly, the reason for that was steadier demand from China. Also, as the euro weakened very slightly over the week, the thought was it might help overseas sales a bit. What else have we got? Well, we've got TikTok progress. It looks like agreement is being reached between Trump and the president of China, President Xi, about the sale of TikTok to an American business. We'll wait and see if that goes through, but politically good. Next week we've got the PCE inflation numbers and purchasing managers index numbers. So we'll see how that works out. But that's all I've got for you today, ladies and gentlemen. Thank you very much. I hope you enjoyed this roundup of last week's financial and economic and investment news. My name's Clive Thompson, and if you would like to, please like, subscribe, and I'll try and answer some questions in the next few hours if I can, if you put them into the comments. Or you can write to me on LinkedIn. You're more likely to get an answer from LinkedIn if you have an intelligent question. And those just like to say thanks. Well, your thanks is enough. Thank you very much. Bye-bye, everybody.